Chapter 24, Regulation. Agencies tasked with protecting the public interest come to identify with the regulated industry and protect its interests against that of the public. The result: government fails to protect the public. Gerald P. O'Driscoll. We live in a new golden age of fraud. Never since the 1920s has financial fraud and grifting been so ingrained in public as today. Yet, the cryptocurrency bubble is entirely built on a single foundation: securities fraud. The investment narrative of crypto assets derives from an uncomfortable truth: selling unregulated financial assets to unsophisticated investors is a great way to raise large amounts of money quickly and with little overhead and oversight. In the 1920s, people raised money from the public on the back of promises of easy money from non-existent oil wells, distant gold mines in foreign countries, and snake oil cure-alls. And yet nothing has changed. Today, we have promises of investments to build financial perpetual motion machines created on the back of promises of decentralized networks, a new digital economy, and blockchain snake oil cures for whatever problem one sees in the world. The securities framework put in place by our grandparents following the market crash of 1929 is based on universal truths about the nature of capitalism. Unless otherwise restrained, entrepreneurs will invariably misrepresent the nature of their business to investors. Investors can only make informed investment decisions if there are full, fair, and truthful disclosures about the nature of the products they are being sold. There is both an information and time asymmetry between those who have domain expertise about a line of a business and those who have capital willing to be put into new investments. In the absence of any regulatory framework, there is a perverse incentive for entrepreneurs to misrepresent the success and efficacy of their products to obtain more capital. As is evident throughout all historical financial bubbles covered in this book, markets do not work effectively when vast information asymmetries or perverse corporate structures incentivize fraud. Crypto fundraising is an absolute nightmare scenario from a fraud mitigation perspective. The initial coin offering bubble of 2018 gave us the most unambiguous evidence of how crypto creates a criminogenic environment for fraud. By allowing potentially anonymous entrepreneurs to raise crypto-denominated capital from all manner of international investors, with no due diligence, reporting obligations, registration requirements, or fiduciary obligations to their investors, we saw exactly what one might expect: a giant bubble of outright scams. Some studies put the number of outright Ico scams at 80%. These companies had no pretense of any economic activity, and the founders simply wanted to abscond with investor money. The rest of the 20% merely fall under the category of illegal securities offerings, companies that sold digital shares as a proxy for equity in a common venture to American investors. Crypto assets meet the United States legal test, called the Howie Test, which defines which types of financial assets are classified as securities and fall under the Securities Act of 1933 and the remit of the Securities and Exchange Commission. The Howie Test defines security as 1. An investment of money by a person. 2. In a common enterprise. 3. Where the person is led to expect profits. 4. To be derived from the entrepreneurial or managerial efforts of the promoters of the project. Crypto tokens do not just pop out of the ether fully formed. They are investments spun up by software engineers that run on a blockchain network and are sold to the public for the pursuit of price appreciation. Every crypto project launched since Bitcoin has engaged in entrepreneurial or managerial efforts that primarily determined the token's value and thus are clearly securities contracts. The public is not buying crypto tokens as collectibles or commodities to fulfill some human need, they are buying crypto tokens to make a financial return in real dollars. Nevertheless, the United States agency responsible for regulating securities has had an exceptionally incoherent approach to enforcing existing securities law. The current chairman of the SEC, Gary Gensler, has made ample lip service to the existing framework, stating, "My predecessor, Jay Clayton, said, and I will reiterate, without prejudging any one token, most crypto tokens are investment contracts under this regime that the Supreme Court put out called the Howie Test." Yet from a matter of public interest concern, the SEC has allowed companies such as Coinbase, Kraken, and Binance to run crypto exchange businesses, list as public United States companies, and sell securities to United States persons, which, at least in his words, are allegedly breaking the law. This incoherence in stated policy and enforced policy is creating a corporate culture in which many United States startups where the rule of law is no longer applicable to their business, simply by virtue of merely declaring themselves blockchain startups as a means to circumvent the Securities Act. Section 1. Shadow Equity and Securities Fraud. In Silicon Valley venture capital circles, a new form of investing has gained popularity, a form that explicitly exploits lax enforcement of the securities framework as a core part of their business model. Usually, when early companies raise capital, such as founding a tech startup, the venture capitalists will purchase equity in the company. This equity is either in direct stock or the right to buy the stock in the future at a significant discount. At some point, if the company is successful, the venture capital investors can either sell their stock to the public in an initial public offering, in which the company lists on a stock exchange, or if the company is acquired, the stock will exchange either for cash or converted into shares in the acquiring company. This mechanism allows venture capital investors to profit, often significantly, from their investments in the company in conjunction with the success of the founders they invest in. The venture investing model is an integral part of the United States tech economy and an engine for enormous prosperity and growth. However, in the post-2018 era, the outsized venture returns seen in the previous era have largely fallen by the wayside. The unicorns, companies valued at over $1 billion, that were once darlings of Silicon Valley, Peloton, WeWork, Uber, and Lyft have not performed like the giants of the dot-com era when IPOing. The unicorn stampede has become a bloodbath in the public markets. Venture capitalists chasing the double-digit yields of the past have turned into increasingly more bizarre, risky, and unsustainable business models as part of their portfolio building. For venture capitalists dipping their toes into crypto investing, this has increasingly meant not investing in equity in their portfolio companies but instead investing in crypto tokens as a proxy for equity, a controversial mechanism known as shadow equity. In the United States, regular equity is regulated under the securities framework, which involves a vast array of common-sense investor protections. The first is that issuers of the equity have a fiduciary obligation to their shareholders and can be held liable if they misrepresent the risks in the company or its financial reporting. In addition, all shareholders of the same class of shares must receive fair and equal treatment in both the information they receive from the company and their proportional representation in the governance of the company. After 90 years of precedent, securities law forms this basis of corporate governance and is a very successful check against misaligned incentives that may lead to fraud. However, with shadow equity, companies are now effectively issuing shares represented by crypto assets or smart contracts, which are securities yet receive none of the investor protections of regular equity. Instead of a traditional equity raise, venture capital firms approach founders of crypto companies and do backroom deals that exchange capital for a percentage of the tokens that the company will issue in a sale known as a pre-mine. For instance, if a company issues 30 million shadow equity share tokens, it might allocate 20% or more of these tokens to its investors before selling them directly to the public. With a regular equity investment in a private company, the stock is not immediately liquid or available for sale until an IPO or an acquisition event. The horizon for such events is typically around a decade before early investors and founders can cash out. However, with shadow equity, there are no restrictions on inside or secondary sales, allowing founders and investors to sell at any point they desire as the sales are effectively unregulated. This structure creates a perverse incentive in that the value of the shadow equity is entirely uncorrelated to the success of the supposed underlying business. Crypto companies with seemingly no business, cash flows, customers, or products regularly have valuations of their shadow equity in billions of dollars, seemingly detached from any business success or even economic activity. This model only works because there is a large unregulated secondary market for these tokens that the public can speculate on, wholly detached from any business fundamentals. Regular equity aligns the incentives of founders, investors, and employees by tying their stock compensation to the company's overall success. If the company is successful, profitable, and builds a product that people need, then its stock will be valuable in proportion to its success. However, the incentive structure of shadow equity does the opposite. Shadow creates a form of moral hazard in which the insiders to the project, venture investors and founders, are incentivized to make the shadow equity appreciate. At the same time, the public speculators are used as exit liquidity, all while there is little incentive to build any tangible product. With a shadow equity funded company, the stock is the company's product. Since the rise of the Web3 marketing campaign, many high-profile venture capital firms, although not all, have engaged in mass securities fraud to juice the returns on their portfolio. Investors' returns on shadow equity are directly offering these investments to the public far faster than any other traditional form of venture investment. A typical Web3 company can have a pre-mine sale, raise $50 million, offer the token to the public in a giant marketing push, and watch the price temporarily soar 10-20x in value in a massive pump while insiders take their profits, and before it all collapses down to pennies on the share, and all this before any pretense of a product is even built. Shadow equity is a somewhat pathological form of fundraising that raises serious moral hazard concerns and fundamental questions about reconciling crypto fundraising with the premises of equity completely divorced from capital formation or productive enterprise. Section 2. Crypto industry lobbying efforts. The American political context is fraught with uncertainty and sclerosis. There is a dangerous line of thinking that the United States has entered a new postmodern political era, an era in which the appearance of governing is more potent than actually governing. The SEC's patchwork of the federal government's enforcement of securities law and nonchalant approach to scofflaw fundraising appears to speak to this indictment. Subversive opportunists have taken the regulatory uncertainty to enrich themselves and commit fraud in broad daylight, not unlike the American gangsters of the 1920s Prohibition era. For the rest of the law-abiding public, we're simply left extrapolating from tidbits of information about the enforcement of laws that have been on the books for almost a century. The current attitude of federal regulators towards crypto seems to be a combination of wait and see and benign neglect, with a view that the crypto bubble is essentially a transient speculative mania and the fire can be left to burn itself out without government intervention. However, the public harm and danger of this strategy are immense. All the while, the cryptocurrency industry has been lobbying lawmakers left and right, attempting to pass beneficial laws which will allow them to circumvent securities laws and create loopholes for them to continue the gravy train perpetuated by open and ubiquitous fraud. The revolving door between government agencies and crypto companies has been prolific in the last few years. Currently, the government risks falling into an irreparable state of regulatory capture where agencies are run by the entities they allegedly regulate. Much of the crypto lobbyist effort for the last few years has focused on three objectives. 1. Pushing the narrative of not wanting to stifle American innovation by asserting that all new technology is unqualifiedly good and beyond reproach. 2. Offers to politicians to create new crypto jobs for constituents in jurisdictions with loose regulation. 3. Funding candidates open to crypto-friendly regulation and putting industry insiders into positions of power in the administration. Section 3. A framework for discussion. Instead, there should be a serious policy debate in Congress about the nature of how crypto assets can or should fit into public life. Effective lawmaking and general consensus building must frame this debate around the issues discussed throughout this book, but primarily around 5 major questions. 1. How do financial assets with no income and intrinsic value fit into markets? 2. Are the externalities associated with crypto assets a net negative or net positive for the world? 3. How do we reconcile the runaway energy costs associated with proof-of-work mining schemes with our climate goals? 4. How do we protect the public against crypto investment fraud? 5. How do we prevent hyper-volatile speculative coins, and crypto assets subject to extreme run risk, from creating systemic risk in the broader economy? Section 4. Regulatory approach. Answering these questions will force lawmakers to engage in a level of public debate and education around the abstract nature of market crimes and capitalism, which will be incredibly fraught in this political climate. However, it would be a challenging debate since there are strong libertarian undercurrents in American society that are unfriendly to even the premise of government intervention in markets, both from the techno-libertarian side of Silicon Valley and in the ascendant MAGA right-wing nationalist movement. The congressperson who champions this cause will have to bridge the political divide and focus on the underlying problems of financial stability, the efficacy of the dollar as the world reserve currency, and the continued operation of fair, transparent, and efficient capital markets. However, positively, these are universal ideals that transcend political boundaries and are essential to every American no matter their affiliation. To that end, there are 3 clear actions that the federal government and Congress need to address to curtail the vast amount of crypto fraud running rampant in today's markets. The path forward is threefold. 1. Regulate crypto assets as securities and enforce the registration laws. Crypto assets are clearly securities contracts. They meet both the legal and practical qualifications for being regulated, just like any other investment contract. To investors, they present with much the same presentation of opportunity, to generate a return based on the efforts of others, but with far more extreme risk. The existing securities framework would vastly mitigate these risks and protect the public from harms that have been well understood by economists and lawyers for 100 years now. Crypto exchanges are currently acting as vertically integrated broker-dealers, market makers, and clearing houses, which introduces vast conflicts of interest prohibited in every other market that trades in securities. In addition, the capacity to trade against the exchange's own clients and use non-public information in proprietary trades produces a criminogenic environment ripe for fraud. The amount of pump and dumps and market manipulation present in crypto markets is unprecedented and is primarily created and done by exchange operators themselves. Massive amounts of non-public asymmetric information, economic cartels, and manipulation are not conducive to either capital formation or financial stability. Exchanges that want to do business with Americans should use entities set up on American soil and registered with the SEC. Instead, crypto exchanges are attempting to perform regulatory arbitrage, using the rules of one jurisdiction to avoid regulation in another. These entities should not be hiding in tax havens using regulatory arbitrage to conceal themselves in jurisdictions with loose financial regulation as they are currently doing. Handling the money on behalf of and safeguarding investments of American citizens must always be done through subordinating corporations to both the judgments of the courts and compliance with the law. 2. Ban surrogate money schemes derived from sovereign currencies. As found in many stablecoin projects, surrogate money schemes attempt to create dollar-like products that mimic public money. However, the products are not backed by the full faith and credit of the United States government, and in many cases not even backed by any hard assets. Stablecoins are subject to extreme risk of runs, much like we saw in bank runs in the Great Depression, an event not seen in the United States in 90 years. There is no reason to return to an era where runs are possible, as the markets already have similar significant risks from money market mutual funds, MMMF, which behave much the same way that stablecoins do and have well-known risks. During the financial crisis and the 2020 coronavirus pandemic, MMMFs required government bailouts. The funds broke the buck and required the United States Treasury to guarantee all $3.8 trillion in outstanding MMMF liabilities. These structures are incredibly prone to risk and create a moral hazard if taxpayer bailouts become increasingly common. The creation of stablecoins in almost precisely the same system, but instead backed by even riskier assets like Chinese commercial paper and other crypto assets, which take the run risk of MMMF and expand it exponentially. Attempting to integrate these stablecoins into the larger economy exponentially broadens the risk of MMMFs to consumers and the economy at large. On top of this, the proliferation of private money simply weakens the dollar's strength both domestically and abroad. Stablecoins are the financial product for which the upside is entirely illusory, and the downsides are catastrophic. The proliferation or integration of stablecoins is not in the interests of the United States from both a financial stability and foreign policy perspectives. 3. Firewall crypto assets away from the banking sector and the broader market. The Glass-Steagall Act, put in place after the Great Depression, set firewalls between different divisions of the banks. The separation of the entity's commercial and investment banking divisions and the restrictions on which types of securities they could handle provided an efficient framework for safeguarding the economy in the post-Depression recovery era. In much the same way, the United States banking system needs to be firewalled off from the extreme volatility of crypto assets. Banks should not handle or custody crypto assets for their clients, create financial products derived from crypto assets, and should not have any exposure to crypto assets at all. This ensures that when the crypto market implodes, banks are not taken down by the collapse, thus avoiding the conditions that may lead to another financial crisis. Section 5. A complete ban on crypto. Alternatively, the United States could consider a path similar to what China recently enacted or to the historical American Executive Order 6102, which forbade ownership of gold. Despite the rhetorical claims to not throw the baby out with the bathwater, there is, after 13 years of crypto, very little evidence that there is any baby at all. Introducing completely non-economic digital speculative playthings introduces nothing to an economy other than slightly more exotic gambling games. In fact, there is a strong argument that such activities may come at an enormous opportunity cost, in the capital and talent that get diverted to ever more extravagant ways to financialize digital nothingness. We can create an entire industry speculating on the volatility of nothingness and turn every fictional thing into a tradable token, but should we? The only overall outcome of this program is the equivalent of digging digital ditches and filling them up again. Perhaps our society has better things to do than digging deeper and deeper ditches and filling them up again. And quite possibly, the Americans should simply ban crypto and play intellectual catch-up with what seems like the rather sensible policy the Chinese have concluded on for the same universal common-sense financial and public harm mitigation reasons.